Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Jamie Ross, manager of the Henderson UK Alpha Fund. Jamie is here today to give his 3 stock picks. Hi Jamie.
Hi Emma.
So what's the first stock today?
So the first stock I'd like to talk about is Shire. So Shire it's a very interesting company because actually this was the one that was the subject of a failed bid by AbbVie, the US, last year. So it's a specialist pharmaceutical company. It has very strong franchises in a few key areas, and those would be ADHD, gastrointestinal and rare diseases. Now it's interesting because recently this company has approached and successfully gone through the process of acquiring a company called Baxalta, which should hopefully complete midway through this year. Now why is that interesting? Because, well, I think the deal is an okay deal. The market thinks it's not a very good deal at all. And so over the last 3-4 months, as news flow emerged that they were trying to buy this company, the shares have taken a real dive. So I think this is a very interesting starting point.
And when the market didn't like the fact that the previous deal fell through either, did it? Shire's shares have had sort of a double hit.
Absolutely, yeah. So the deal, when that broke last year, that was a huge surprise to everyone. So the shares took an absolute pummeling then, and have actually recovered very strongly since. But again, then started to, as you say, take that double hit when people started realising they were going to buy this US company. So it's an interesting starting point. You know, as a fund manager, when you see a share price chart that looks so negative, it's always something that's interesting. It's always a starting point to go and do the work on a company.
And M&A is also a trigger for the second stock that you're going to highlight today as well, isn't it?
Yes, indeed. Yeah, this is a very different proposition. So the second stock is a much smaller company. Shire's 25 billion market cap, something like that. The company that I've, again, recently initiated the position in is a much more mid-cap company, about $1 billion market cap, and that's bwin. So bwin is a online gaming company. It's got a lot of exposure to Germany, which is I suppose the way to describe it is a grey market, a pseudo-regulated online gaming market. And what's particularly interesting about the company at the moment is that they are the subject of a reverse takeover by GVC, which is an AIM-listed company, which is much, much smaller. So GVC is 300 million market cap and is buying bwin. Now, why do I think this is interesting? Well, it's really my analysis on the combined entity, so what this company looks like post the deal. And what it looks like is this. It's a company that, if you bolt together the earnings of both companies, it has about 150 million euros of EBITDA. And then I believe that the cost synergies that they can extract from this deal are probably about 125, and that's a number that GVC management have talked about. That's a number that bwin are very happy with. So it's a huge amount of cost that can be extracted. Once those costs have been extracted, this is the cheapest gaming stock, and in my opinion, on a cash flow basis, one of the cheapest stocks in the FTSE.
So from something pretty exciting to something quite boring.
Yeah, certainly operationally, and I hope management of the company aren't watching as I describe their operations as pretty mundane, but the next company I'll talk about is Berenstain. So Berenstain, in my opinion, is a very good company. It has many of the characteristics that myself as an investor really like. And so what does it do? Well, essentially, Berenstain cleans mats and workwear. So as I was saying, a pretty mundane activity. But it's interesting. And it's interesting because this is an industry that 10 years ago, 15 years ago, was operated and run by very small family-owned businesses. And increasingly it's consolidating. And the consolidated entities, one of which is Berenstain, have a far stronger margin and return profile than those independent family-owned businesses did. So the business is a better business than it would have been 10, 15 years ago. Why now? Well, the company have just changed their CEO. Now, the old management team, very strong, very highly regarded, no issues with them at all. But what's interesting is that the company has delevered quite a bit over the last decade. And the balance sheet, they've always targeted somewhere between 1 and 2 times net debt to EBITDA. And right now, they're operating at about 1 times. Now, we've got to bear in mind that this is a very stable, defensive, as I said, quite boring, cash-generative business. So for a balance sheet that's that undergeared, we think there's an opportunity actually to use that balance sheet slightly more aggressively. And the new CEO, James Drummond, who's coming in, has alluded to the fact that he might be a bit more aggressive on M&A. And if not, I believe we'll get some cash back as shareholders.
Jamie, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.